All right, option traders, we're going to be talking about a very important subject today. I get a lot of emails from people that buy options. They buy call options, they buy put options, and they think that once they buy that option contract, that the option value is going to stay the same regardless of what happens with the stock. So if the stock doesn't move, they think, oh, my option price is just going to stay the same. Well, if you're one of those types of people that thinks that, then I've got some news for you today, because we're going to be talking about a subject called theta. Time decay. As an option goes through its lifespan from the time that it's purchased or sold until expiration, it loses a little bit of its value every single day, regardless of what happens with everything else, regardless of where the stock goes, regardless of what volatility does, regardless of what interest rates do, doesn't matter. Theta is a very important subject when it comes to options trading, specifically if you're an options buyer. So what we're going to do today is we're going to talk about theta, how it works, what happens. I'm going to show you some actual option prices. We're going to look at an option calculator, and we're going to see how the options value declines every single day, no matter what happens, due to the passage of time. So like literally, as we sleep, the option value is going to decrease over time in the middle of the night, just because we turn the calendar from one day to the next. Okay, so we're going to talk about that, and we're going to talk about how or ways that you can get around that, specifically if you're an options buyer. All right, so let's just jump right in and talk about theta today. All right, everyone, Lee Lowell here from smartoptionseller.com. What you see in front of you is the Smart Option Seller Guide to Theta. So for those of you that are newer option traders, specifically option buyers, whether you buy call options or put options, theta works for all of them. You need to understand the concept of theta. And I also made a video about this a few weeks back, and I'm going to put that on the screen towards the end of this video so you can watch that one as well. So you really need to understand what theta is, because it's going to help you decide which option contracts to buy. All right, so let's just talk about the concept of theta, what it is, and how it works. And we're going to look at the option chain. We're going to look at an option calculator. We're going to do some what if scenarios so you can actually see what happens to these option values. So let's just go down the list here, and then we'll start looking into some examples. So theta is one of the Greek outputs of the option pricing formula. We've got delta, gamma, theta, vega, and rho. There's 5 of them. Okay, and the last video I talked about delta, and a few videos ago, I also talked about theta a little bit more. So theta is a number that signifies the daily amount of time decay that an option goes through. So between today and tomorrow, the option value is going to lose some value. It's going to decrease in value just because we went to sleep at night and we flipped the calendar to the next day. The option value does not stay the same from the way it closed the day that you may have purchased it to the next day. It loses a little bit of its value every single day due to the sheer passage of time. Okay. So a couple other items about theta is that theta, the actual daily decay, gets larger each day the closer you get to expiration. So if you think about an option that's 1 year out in time, its daily decay is small. But as you get closer to expiration, we're talking the last few weeks of life of an options contract, that daily decay gets even larger. All right. And also, the theta is largest for at-the-money option strikes. What's an at-the-money? The at-the-money strike price is a strike price that is closest to the current price of the stock. So if the stock's at 100, the at-the-money strikes would be the 100 call and 100 put. So theta works the biggest, or theta has the biggest effect on at-the-money strikes. All right. Now, if you're an option buyer, you know that when you buy an option, you want its value to go up. So hopefully you can sell it for a higher price and lock in a profit. So as an option buyer, you're at the mercy of theta. Theta is a guarantee. It's going to happen regardless. So if you buy an option, you have to know that each day you're going to lose a little bit of your portfolio value, because that option is going to decline in value no matter what else happens. So you have to be prepared for that as an option buyer, specifically if you're buying at the money, close to expiration options. those are going to decay very quickly. You're going to go to bed at night thinking the option's at one price. You wake up the next day, the option's lost its value. So Theta works against option buying, and it helps option sellers. And this is one of the reasons why I became an option seller over 30 years ago, because in most cases, option selling is to the advantage of the option trader. And I'll talk a little bit about that later on. So for option buyers, here's some things that can help offset the decay. The decay is going to happen no matter what. So the only way for you as an option buyer to offset that decay is that the stock has to continually move in your favor. So if you're bullish and you buy call options, which is a bullish strategy, the stock has to move up in order for you to make a profit. But if the stock doesn't go anywhere, that time decay is going to really take over and drop the value of that option. So as an option buyer, we're talking about call options here, you need constant upwards movement of that stock to offset the daily time decay. So you need to make sure, number one, that the stock is going up, and you need to make sure that it keeps going up while you have the position in your account. All right. Another reason why I default to being an option seller is because a lot of times stocks don't cooperate. They move in the wrong direction, or they just don't move at all, which is really great for option sellers. And I'm going to give you a little bit of information down the road. So what we want to talk about, and the last thing here is that, as I mentioned earlier, longer dated options has smaller time decay, daily time decay. So let's just jump right in and discuss what option Theta is all about. So what you see on your screen here is an option chain from Interactive Brokers. This is the broker that I use. If you don't have an options broker yet, look down in the description. I have a link for Interactive Brokers. You can take a look at them. If you sign up, open up an account with them, they'll know that you came from me. So that's if you need an option broker. So we're looking at Apple options here. Here's the symbol for Apple. And we're going to look at a couple different expirations to show you the difference in Theta. So we're going to key in on these 1 week options. December 6, 2024. It expires in 6 days. Here's the last price of Apple up here, $237.49. This could have been in the aftermarket session. All right. So call options on the left, put options on the right. And here's the Greeks. We got the delta, gamma, vega, and theta. So we're going to concentrate on theta today. And the put options and call options each have their own delta, gamma, vega, and theta. Now, since Apple closed roughly $237.50, the at the money strike, which I told you is the one that's closest to the current price of the stock. So we're going to key on these 237.5 strikes. We're going to look at both the calls and the puts. Theta column right here. So with 1 week left, 6 days, and Apple has expiration every Friday. Okay, so in this case, we have 6 days left until these options expire on that Friday, December 6th. The 237 calls has a theta of 0.176. That's actually 17.6 cents per contract. Now, if you look over here, this is where the contract went out on Friday. What was it? Friday, November 29, 2024. 216 bid at 226. So something right in the middle would be $2.21 per contract. Okay, these are per contract. $2.21 is right in the middle. And what's going to happen is, so what that means is with Theta at 17.6 cents, just because we turn the calendar and if everything stays the same from today till tomorrow, this option is going to lose 17.5 or 17.6 cents per contract, just because we flip the calendar to the next day. So we're talking about roughly if it's 221 today, it's going to be worth about $2.04, $2.03 per contract. Tomorrow, as we sleep, turn the calendar over, you'll wake up and see these options right here, these call options lost about 17 cents per contract just for doing nothing. Right? So if you're the option buyer, if you bought these things for $2.21 per contract, tomorrow you wake up, Apple's at the same price, $2.37, $237.49. I'm sorry. If the stock didn't move at all, these things are going to be worth about $2.03, $2.04. So you have to understand, as an option buyer, you're losing value each day. And as we said, the theta gets larger the closer you get to expiration. So if we go out 1 week in time, if we give ourselves an extra week till expiration, you'll see these 237 calls are only losing 12.8 cents per contract. So the theta is smaller the longer you go out in time. So let's go out about a year in time, and just so you can see. So December 2025, we're going to look at, here's the expiration, 384 days from now. They don't have the 237 and a half strikes, so you got to either choose the 235s or the 240s. Those would be considered at the money, and you can see both of them have a theta of 4.2 cents per contract, meaning the option will lose 4.2 cents due to the changing the calendar from one day to the next. So if you don't, as an option buyer, if you don't want to lose as much value of your option contract to the daily time change, you want to key in on a longer time frame. At the same time, though, the option is going to cost a lot more. So these 240 calls are worth about $26.50 per contract. That's $2,650. $2,650 versus these 1 week options that only cost $221. So you're paying like 10 times more for the option contract, and the theta is smaller. So you have to decide as an option buyer, what are you looking to get out of the trade? Are you short-term speculator? Do you think that Apple's going to move higher really quickly, really, in your favor? You have to decide how much time you want to give yourself, okay? And now conversely, if we look at the put options for these 1 week options have about a 14.8 cent theta, meaning it's going to lose almost 15 cents per contract just by turning the calendar to the next day. Now, how do we know that theta will actually work? Okay, so what we want to do is we can consult an options calculator. Now, I've been showing this in some of the last few videos I've made. Barchart.com has a free option calculator, and most brokerages have their own option calculator within their own trading platform. So you can use that as well. But I like to show it on barchart.com. It's a very easy calculator to use. So we're going to look at Apple here, and we're going to go down to these. Here, let me just refresh the page here so we all start together. Now, you can see Apple's at $237.33, which is a little bit different than what the Interactive Brokers had, because Interactive Brokers probably had the aftermarket hours trading. And we're going to change this to the December 6th options. If you're not familiar with how an option calculator works, you have the inputs on the left side and on the right side here. And also, if you use bar chart, I'm going to just tell you, since it's a free product, you're going to have all these ads and things all over the place. So just, bear with me here. The inputs on the left, outputs on the right. So you get the theoretical price of the option contract. And here's your Greeks right here. So with Apple, we have the December 6th. You got 6 days to expiration. Here's the stock price. Here's the strike price. We're using those at the money calls we're looking at. And you can see the option value is roughly $2.22. We calculated it as about $2.21. And you can see the theta here. Bar chart has it just under 20 cents per contract. That's a little different than Interactive Brokers, where it was about 17.6 cents per contract. And that probably has to do with the volatility numbers that they use here. If you want a little cheat sheet here, let's go back to the option chain. You can see this little thing in the upper right-hand corner. It says ATM IV. That means at the money implied volatility is 16.8%. So that refers to the at the money put and calls, their implied volatility. So they're showing it at 16.8 on the calculator. They have volatility at 18.4. So that's probably part of the difference of why the theta looks different. But it doesn't really matter. I want to show you what happens. So let's just assume everything is the same here. We're going to take the days to expiration down by 1 day to see if this option loses about 20 cents per contract. So once I change this from 6 to 5, this option contract should be worth about $2.02 per contract. That will show you that theta works as long as everything else stays the same here. So let's just change this down to 5 and key in right here on the 222. Change this to 5, and you can see right there the option value changed to $2.02 per contract. So with everything else being equal here, is once we flip the calendar by 1 day, you're going to lose, if you're an option buyer, you're going to lose about 20 cents per contract just because you went to sleep and you woke up the next day. For the option sellers out there, if you were the seller of this call option, you wake up the next day, you're 20 cents per contract richer, which is 20 actual dollars. Okay, so another reason why we like to be option sellers is because we like to go to sleep and wake up the next day and have more money in our account. Okay, that's the way we do it. And as you can see, the theta got even larger. Yes, the day before here, let's go back. With 6 days left, the theta is just under 20 cents per contract. 5 days left, theta has jumped to 21.7 cents per contract. If we go down to, let's say, two days left, now we're talking 33 cents per contract that the option is going to lose overnight. So if you're, as I said, buying these really, really short-term expirations, you're going to give up a lot of value because of the passage of time. Now, as I said, the one way to get around that, because we kept everything the same here, let's change this back to 6, start over. The only way to get around losing the 20 cents per contract is that Apple stock has to move higher in your favor to offset the 20 cents per contract that you're going to lose. So now, since the at-the-money options have a delta of roughly 50% or 50 cents per contract, you can see right here, delta, look at this as 50 cents per contract. And the theta is 20 cents per contract. So really what you need to happen is that you need Apple stock to move up enough for the option value to move up as well to offset this decay. So for every dollar that Apple moves higher, Apple stock moves higher, the call option value will go up 50 cents per contract. And if you factor in the 20 cents that you lose here, Apple has to go up roughly, let's say, is it 75 cents or so? So let's just take this up to $230. We're going to take this up to $238. We're going to knock it back down by a day and see if Apple moved up enough to offset this decay, okay? So we're going to take this up to $238. That's about a 67 cent increase in the price of the stock. And we're going to take this down by 1 day. Remember, $2.22 is where we're starting, okay? So there you go. Because Apple went up about 60-something cents per share, the option contract went up enough to offset your time decay. If you bought this thing for $2.22, now you're up 15 cents per contract. That's because Apple went up. So let's move up another day. Let's go to 238.50, 238.5, and take this down by another day. Okay, so now you're still making money, You bought it for $2.22, it's up to $2.43. So as long as the stock is continually moving in your favor, then you're making money. So let's just say that Apple drops the next day back down to $2.38 and we knock this down a day. Okay, so now you're down by 4 cents per contract. You bought it at $2.22, it's worth $2.18. Theta is getting larger. Apple, didn't we take this down to $2.38? I thought that's where we went, $2.38. So now it's worth $1.89. So what happens is if you're playing with these very short-term options as an option buyer, the stock has to continually move in your favor in order to keep offsetting that daily time decay. If you're an option seller, as long as the stock's not really moving very far, if you're playing these short-term options as an option seller, you're going to be making money. This one thing that we like to do is sell put options. That's what we do with the smart option seller. We'll go over that a little bit. So as you can see, if you're playing short-term options, the option value is going to lose a lot each day. So the stock has to move in your favor if you're an option buyer. Now, one of the things you need to do as an option buyer is that you need to make sure you know where the stock is going. So one thing we like to do at the Smart Option Sellers when we make our trades, we need to make sure we know which way a stock is going. So here's a chart of Apple up here in this section is the daily chart of Apple. Getting close. Here's the price, $237.33, moving up pretty good. So if you want to buy call options, if you're bullish, you want to make sure the stock is moving up. Don't, buying call options while stock is moving downward. Let's look at Merck real quick. This is Merck. Okay, Merck's just been going down, 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 down. So if you're going to play bullish on Merck trying to pick bottoms, you're going to be fighting a losing battle because it's already in a downtrend. It's going to keep moving in a downtrend until it actually starts getting into an uptrend. So you're playing in this way. If you're bullish and you're buying call options, this is tougher to do versus Apple, which is already in an uptrend. Okay, so you want to play with the trend of the stock. That makes it easier for you to make money as an option buyer. Now, as I said, if you're playing those short-term options, the stock really has to move in your favor. If you're playing the longer-term options, like the 1 year out in time, your daily time decay is smaller. So you have more time for the stock to move in your direction. Then the other thing I want to say is that you don't have to hold an option to expiration. You can get out of it at any time. If the stock moves in your favor in a day or two and the movement offsets that daily time decay, take a profit. Get out, take your money off the table. But a lot of people like to wait all the way through expiration because they want to just see it through to expiration. So you really have to make sure that the stock moves in your favor as an option buyer. Now, a majority of the time, unfortunately, the stocks don't cooperate. They'll fluctuate up and down. They'll go up a little bit in your favor, and then they'll drop back down, and you'll lose all the gains that you've made. So that is one reason why we like to be option sellers. I've been an option seller for over 30 years. Let's quickly go to our website. I just want to show you what we do here. At the Smart Option Seller, our main gig is selling put options and selling put option credit spreads. We don't sell call options because that has unlimited risk. We like to sell put options, which works better in a bullish environment. Since the stock market goes up continually over time, selling put options is a great strategy because you're going to make money not only from the daily time decay, but you're going to make money because the stock market usually goes up over time. And that's a big win for us. So if you want to understand a little bit about what we do with the Smart Option Seller, which is mostly selling put options, get our free ebook here. Go to our website, smartoptionseller.com, click on the free ebook. And this is an ebook that I wrote, Put Selling Basics. It's all about put selling, what it is, why we love to do it so much. Scroll down, put your name and email address here. We'll send you an email back with a link to the copy of the Put Selling Basics. If you want to take a deeper dive, we have our video series here. It's a 5-hour video series. You get 30 days free to our newsletter where we actually sell put options, so you get to see how we do it in real time. Okay, so this is you can look at our video series here, and what we have here's our services tab. We have 2 newsletters: Smart Option Seller newsletter, Vertical Spread Trader newsletter. We have our one-on-one coaching sessions. If you want to get a leg up, if you need some help, we can help you with that. Look at our coaching series, and we also have a probability calculator, which is a cool little tool to help you figure out, what are the chances of a stock moving from point A to point B within a certain amount of time. All right. So those are the things that we like to do here. I hope this video has been helpful for you. Let's bring up the Word doc one more time. You can take a look at this. In the description below the video, I have some links, some books, some websites that could be helpful to you. Take a look at those. Give me a thumbs up. Give me a like. Don't forget to subscribe to the channel. I really want to make these videos go viral here if we can. Tell a friend. Send me an email. I'll always answer your emails. What else? I think that's about it. Oh, yes. On the screen here, I'm also going to put the other video that I made recently about Theta, so you can watch that as well. All right, that's all for me. I hope this video has been helpful. Make these free videos for the trading community. We all want to become better traders. All right, this is Lee Lowell. I'll see you all in the next one.